Hello ladies and gentlemen, and welcome back to the channel. Today we are going into 3 dividend stocks that I see as good plays during the whole virus situation during the month of September 2020. Some stocks that I may potentially buy, some stocks that I would recommend potentially as well, but obviously this is just my personal opinion, so take that with a grain of salt. As you guys see, the Dow Jones is down $252.37 today, or about 88%, or 0.88%. If it was down 88%, that'd be terrible. Before we get into today's video, go ahead and hit the like button and subscribe to the channel if you haven't already. That's the best way to show your support for the channel. It's free. When I watch videos, usually the first thing I do, if I like the commentator, if I like the video premise, I go ahead and drop a like within the first minute. So I really appreciate that if you guys would do that as well. And let's get right into it. The first stock that I believe is a good dividend play and potentially a decent little growth potential is Lowe's company, ticker symbol LOW, currently down about $1.50 today, at $164 per share. The thing I like to see here is a 1-year target estimate of $181. Yes, you see there's a bearish outlook. And honestly, if you got in right here, and I was actually looking at this company right here, you would have made 100, I guess that's about 150, maybe 200% return on your money, which would have been incredible. But the big thing we're looking at here is a forward dividend of 1.45%. That's something that you may look for during this time. It's obviously it's obviously really nice to have some sort of consistent cash flow. EPS is 7.5. PE ratio of 21.85, so it's not super overpriced, if you will. It's actually a relatively reasonable price, and 1.43 beta, so a little more risky than your average, about 50% riskier. If we look down at the analysts, we have 8 strong buy as of August, 10 buy, 13 hold, and 1 sell. Me personally, I think this isn't a buy situation. I don't know if it's necessarily a strong buy, especially given the price tag, but then you come down and look at these things. So obviously you see the average rating is 1.9, or about a buy. Currently it is at 163, the low is 146, and the average is 181.5. So a lot of good potential in this stock. One thing I want to point out here, so the market cap, as you guys have seen, kind of grows year over year. Lowe's is just a really good company. They got a great CEO. They've done really well over the course of the whole virus situation, of keeping in-store sales, of promoting online sales. Obviously, if you guys don't know, they're very similar to Home Depot, and honestly, I think they're better than Home Depot. Home Depot actually pays a decent dividend right now as well. They specialize in home projects and paint and lumber, and they might even have some groceries. Obviously not like milk and stuff like that, but it may be kind of similar to a Menards. As you guys see, trailing PE of 22, forward PE of 22. I do like those numbers there. Let's keep scrolling down here. Profit margin of 7%, operating margin of 10%, return on assets of 11%, return on equity of 163%. That's a great number to see. Gross profit of $23.1 billion. That's a really good number as well. And here's a number when you're looking at dividend ratios. You kind of want to view the payout ratio on something like this. Usually my rule of thumb, if it's under 50%, that's a really good buy in terms if it's a good company as well. Obviously this is around 30%, so there's a lot of room for that growth. Say they go to $200 per share, and then they don't see a lot of growth from there, so they just start paying out a dividend, and they can increase it from that 30%. They could go all the way up to 75%, and that'd be something to look for here. So I think Lowe's is possibly the best dividend stock currently out there right now, given the current situation. I'm really high on Lowe's. The next one is a company I'm not so high on, simply because I don't see there's a lot of growth coming out of this company, Skyworks Solutions. I think you would have been best to get on the train around here, obviously, or even somewhere in here. Now it's at 142. You see the 1-year target estimate of $141. Bearish, and then positive long term. If you don't know what Skyworks Solution is, they do work in the microchips and stuff like that with phones and computers. So they are a big technology company, and they've sort of rode that wave of, obviously not in the last month, but the technology boom over the course of this. You do see a PE ratio of 31, so I think it's a little high for price. As you guys can tell, again, the 1-year target estimate is currently lower than what its current list price is. So this one would strictly be a dividend play. You see a 1.39% or a 2 dividend yield, $2 dividend. You come down to the analysts on this one. You got 7 strong buy, 15% buy, 5 hold, and 1 underperform. Close to a buy on this one, and again, it's overpriced in the analyst rating, and honestly in my personal opinion as well. So this is strictly a dividend play. You look at their statistics here. The market cap has grown essentially year over year besides this year, or I guess that quarter. And then you look at the trailing PE of 30, forward PE of 20. Decent numbers there. Profit margin, return on equity of 18%. And then you look at something like Lowe's that was 163% or something like that. Obviously, Lowe's is the better company in that situation. Payout ratio under 50 still, 40%. So that is good. I do like that rating right there. That ratio I do think is a solid ratio for a dividend play. There's room to grow. And again, I think, excuse me for that, I think that if you're going to buy Skyworks Solution, this is certainly a strict dividend play. I wouldn't expect any growth, and I would honestly probably expect a little decline in price from this point unless it continues riding that wave. But I don't think it's at the forefront of any of that. So this is strictly a dividend play, and it's a good dividend play. Like I said, there's room for growth in that dividend, and obviously if the numbers keep showing up, maybe they'll boost that dividend, and that could potentially boost the stock price as well. And then the final one that I have been looking at, the one that you guys have probably heard a lot about, is CVS. They've been in the news recently. They're going through a little bit of trouble for making people work during the virus that maybe shouldn't have been working, and I think that's hurt their stock price. If you guys look at the last month or last 6 months, obviously they reached the high there, and if you look at the year, so they're down on the year despite having a lot of prevalence in the current situation, a beta of 0.7, so not super risky, and then a dividend of 3.16%, so a solid dividend there of about 2, and then PE ratio of about 10. So you look at that and you see a number that's really low like that. I think this could be a potential good buy. As you guys see, 5 strong, 10 normal, and then a 9, I believe that is. Yeah, that's a 9. So right around a buy. And then the average rating for this is $80, and it's currently at 62.39. So it's lower than the lowest analyst one. So even if it only goes up $3, you're still making money. I think potentially some of these could become downgrades, just given the issues that they've been having. But as you guys see, if you're going to get tested for the virus, obviously CVS is a really big one. I think CVS is essentially nationwide, and so you may get your number one place to go besides maybe a hospital would be a CVS. So that's really something to look at there. Let's go to their statistics real quick and wrap up this video. Market cap is staying relatively steady. I don't love that trailing PE of 10, forward PE of 9. So obviously it's a very interesting buy-in point currently. Return on equity of 12%. The payout ratio, once again, 31.8%. Obviously, there's room for growth there. So even if this stock doesn't go up in price, and it's hard to tell. I don't see this stock going much lower than $50. And even if it does get down there, you're still making that dividend, hopefully. Let's see if I can find the 52-week low. So yeah, $52. I could see it potentially going back down there, but it's CVS. It's going to come back eventually once this scandal clears. once they potentially change things up. It's really this and Walgreens are the two big like pharmaceutical companies that sell the pharmaceuticals and stuff like that. I know CVS is always the one I've gone to, so I really think this is an interesting play here. Definitely CVS and Lowe's would be the most interesting ones, with Lowe's potentially leading that, just because I like their company model a little bit better. But let me know what you guys think in the comment section below. If you guys have any dividend plays that you guys currently like heading into September. Those are the three that I like, with Skyworks being more of just a strict dividend play, the other two having some potential solid growth to them. So yeah, let me know in the comment section below if you guys have any dividend plays that you like. Go ahead and hit the like button if you haven't already, and subscribe to the channel as we continue our climb to 1,000 subscribers, and then to wherever we head after that. So really appreciate you guys for watching this video, and until next time, happy investing.